Jim Stenning from FIG Securities. Jim, great to see you. Thanks very much for coming in. Let's just firstly talk about how the US economy is faring, because what we've been seeing on the markets has just been incredible. Driven by, I guess, better than expected data, plus the fact that the earnings season hasn't been as bad as what everyone thought.
Yeah, that's right, and that's been reflected in longer term yields moving sharply higher. And interestingly, just as the previous week they'd moved sharply lower, but it really is a bit of a resumption of a trend. We have seen long-term rates moving higher over some time. Again, that's consistent with a recovery, a removal of that sort of flight to quality buying, and indeed a reversal of that. So look, I think it makes sense that if we are on the road to recovery, we are going to see higher yields. But it's a fairly big if at this stage.
Let's just have a look, because I think we do have some of the benchmark yields for the week to date there, so if you could just take us through those.
Yeah, sure. Okay, well across the board we've seen rates move higher. I think in Australia the supply story is coming back to the fore. We've seen recent discussions about that. Interestingly, we haven't really seen too much compression in credit spreads during the week, so that sort of flies in the face of the equity rally. I think that probably will come. I think credit spreads are reasonably well supported where they are. But I also think that we will see a resumption of longer term yields moving higher in this country as well. So we'd expect to see government bond yields higher again next week.
Okay, one to watch there. The problem, though, I guess, is, like you say, it's so choppy. I mean, one minute the confidence is gone, the next minute it's back. What are the problems, volatile, I guess, with that key US economy? Because we're happy as Larry about it at the moment.
Yeah, look, everything seems great in the last 48 hours. But look, there are some fundamental things that are happening over there. I mean, sort of anecdotally, if you look at, say, the recent developments in California. Here we've got a government issuing IOUs to non-priority for non-priority payments. I mean, it's a bit like something you get from a dodgy mate in a card game, an IOU. But it's sort of I suppose symptomatic of what's happening over there. They're living through the wreckage of the GFC at that sort of not only the state level but at the local government level. So there's probably some fairly nasty things to come out of that in terms of the monoline insurers and other sectors that are affected by that. So it's something to watch. Also, I think this morning there's been a whole lot of talk about CIT. CIT, it looks like now, will file for bankruptcy. Very interesting development there. I mean, obviously they're on the cusp of that too big to fail definition. I think we've had a bit of a line drawn in the sand there. I think that obviously they were in discussions, so it wasn't a definite no. But they're a fairly big entity, and it seems to me that allowing them to fold is a fairly big signal.
Could that be the news, though, that, I guess, sends the confidence crashing again?
Look, it could be. I don't think it's very good for credit markets. One of the problems with CIT is that it's a large company. To put it into perspective, it's sort of a baby GE Capital Finance. And they have global representation. They're in Australia. So I think that will have a knock-on effect. In fact, a lot of the structured credit portfolios, the CDOs, have exposures to that issuer. So it will have a knock-on effect globally.
And what do you think? I memean, should the government step in and help out?
Help out CIT? Yes, well, I guess they've said no, and it's a near-term thing, so there's some ambiguity in the statement. I think it's only very recent.
Yeah.
But look, I suppose on one side of the fence, they've got to start to draw the line somewhere. I think in the long term, it might actually be a healthy thing that they let it go.
Oh, but then we have the only too recent memory of Lehman Brothers, don't we?
Well, we do. I mean, hopefully we're out of those woods,
yeah.
Hopefully we won't see anything like that again.
Okay. Just turning to all of the capital raisings, because that just continues and continues. I mean, the numbers are stunning. I mean, what are the implications of this, though, down the track for
I guess in the short term, it's not very good for equity holders. I mean, a lot of issuers have really sort of cashed in their get-out-of-jail-free card. There's a lot of demand for their equity, and so investors have recently demonstrated they've got this insatiable appetite for ordinary shares. But unfortunately, the debt markets are closed to these investors still, particularly a lot of corporates, not so much the financials. So really, these issuers need to, or the market needs to recover before they can take advantage of it.
And certainly, I guess, looking at the different sectors, one of those in particular where we have seen even more capital raisings than others has been the property sector.
Yeah, well, that's good. I mean, it's good for bondholders. I think, you know, when in order of payment, when a company falls over, if you're a bondholder, you sit above an equity holder. So the more equity there is underneath you, the better it is for you. So that I guess the risk in that investment becomes lower. So it actually is a really good thing in terms of the debt markets going forward.
Okay, and just finally as well, speaking of the credit crunch, the cost of funds for the credit unions. I mean, they're now paying more for their funds than they lend it as. I mean, can this be sustained?
Yeah, well, I guess that's obviously not. What we saw during the week, as evidence of that type of situation, or their margins being condensed. And it's the same thing for the regional banks, the building societies and the credit unions. Is we saw Heritage Building Society come to the market with a government guaranteed issue. And the net margin, if you build in all of the costs for the insurance to pay the government for the government guarantee, is about 230 points over the bank bill rate. So that comes in around the mid-5s, and obviously, you know, to compete in the home lending market, they need to be lending at those levels. So really that's not sustainable. There's an argument that those smaller ADIs should be paying the same amount as the larger ADIs or the big four. Obviously that doesn't sit well with the big four. But on the other side of the equation, timing-wise, what we've got is the AOFM, their buying of residential mortgage-backed securities that a lot of these smaller players originate. So they use a warehouse to take assets off the balance sheet. That buying is drying up. So the government has said that they'll provide $4 billion to ADIs. I think they've done something like 3.9, or I beg your pardon, 3.2. So it is coming to an end. And so for a lot of these banks, they've got to make a decision: do we continue to lend, or how do we reduce our cost of funds? And I think, you know, realistically, that's a problem for the regulator and the government as well.
So, I mean, what can be done to ensure that they're viable? I mean, they're such a crucial part, aren't they, of the market?
Yeah, look, it's very important, I think, because in a global financial crisis or in a downturn, net interest margin for the banks should widen as risk premiums are built in. But also, as defaults come through, obviously that's going to affect your bottom line as well. And unfortunately, what's happening to a large portion of the ADI sector is during the downturn, the margin's actually being squeezed. So I guess the good news is that the exposure really is fundamentally to the residential property market, which doesn't seem to be suffering as badly as perhaps people thought 6 months ago.
Yeah. It's been great, as always, to get your analysis. Jim Stenning, FIG Securities, thanks so much for your time.
Thanks, Brodie.